Okay, this is a good one, guys, because we are live. This is Everything Phoenix, so it's always good. But we are specifically today talking about the single hottest topic in probably America, not just real estate, not just Phoenix. That is the tariff situation. So we're going to address this right now because I think we need to get out ahead of this. And so we're going to talk about tariffs and how it affects the local economy here in Phoenix, the national economy, and we're going to talk about the housing economy here in the Phoenix area. And of course, some development, guys, but we're going to talk about tariffs. And so I'm going to jump in here and talk about what it means in terms of the housing market, the future of it, especially in the short term and the overall economy. Okay. Now, if you're watching, before we jump into this, I have a great economic lesson in general to talk about inflation, deflation, and deleveraging throughout the economy and how it works, summarized really quick. It's going to be cool to watch. I'm going to jump in that here in just a second. Okay. Now, before I do that, if you don't mind, just let me know where you are watching from. That'd be great. I actually got roasted in the comments here just a little while ago, which is totally cool, for not replying during a live in terms of the questions or comments that people had. And I apologize, guys. I always reply to the ones I see. So if I miss them, I apologize for not replying to the comments that were and questions that were asked, because that is the point of doing a live. I want to make sure that any questions you have, you can ask as many as you want, because if you're thinking it, someone else is too. So don't be afraid. Jump in there and ask the question. And until we have some questions or comments from people, until we have people commenting where they're watching from, it helps curate the algorithm. I'd really appreciate it. Just hint, hint. But outside of that, we're going to jump right in here. I'm going to share my screen, and we are going to talk about a quick little economic lesson. Okay, now this is from a video of Ray Dalio, and he does a great job of just going over what the overall economic principles mean. Okay, so I'm going to share my screen, and we're going to rock and roll. Here we go. All right. Okay. Now, that was inflation. I'm going to go back over to the screen here and talk about deflation, guys, because the opposite of inflation to an extent is deflation. And so, in the situation here that we're in with tariffs happening right now and the reactions from many of the countries around the world, which, by the way, some are very, very positive, some are not so positive. And with all that information, they're trying to level the playing field of trade. We're going to talk about deflation because now people are talking about what if this turns the opposite way, because we were in this high inflationary time for the past several years and it goes the opposite direction, because that's not good either. Okay. So now let's talk about the opposite of this, which is deleveraging. Okay. I'm going to share my screen and get this ready to go for you guys right now. Here we go. Okay, guys, my fault. Apparently, I was just told there's no audio on that, and I don't know why that's happening. That is a bummer. My apologies. Shoot. I'll get that figured out, and we'll have this ready to rock and roll for next time. So I don't waste any more time on this from you guys. So I apologize, guys. I know you had closed captions on there, but there was no audio. Unless you want me to keep going. Now, Luck, let me know. Hey, Luck, thank you so much. I love your comments. Is it evil for me to hope the housing market crashes? Let's keep going here. Not just a crash, but a collapse. And then, of course, you let me know no audio in the video. So thank you very much. I can clearly hear it here. And so I don't know why that is happening or have some technical difficulties. I'll make sure I get that figured out for next time. Okay. But thank you for letting me know. I wanted to go over that video. And then the best part is what he calls, Ray Dalio, a beautiful deleveraging, which is the way you do it the correct way. Essentially, he goes on to say that there's a way to do the deleveraging the correct way so it doesn't go just basically crash the opposite way. And in doing so, that's what everyone should be striving to do, which takes a little bit of everything combined at the right amount, not overreacting to one thing or another. So again, to answer your question, Luck, not just a crash but a collapse, is it evil? No, I don't think it's evil. Keep in mind, guys, I've already been through this. I got in real estate in 2005, excuse me. This is my 20th year selling real estate here in the Phoenix Scottsdale area, and we went through it. It was terrible, right? And there's a difference between a full-blown depression, which is a huge, almost deflationary area, and then a recession, right? And the difference is that when you're in a deflation, the recession, you start to hit the recession, the Fed can do what? They can lower rates. They have that lever. They can also print money, quantitative easing, which we saw in the past, but they can lower the lever of the rates. Well, in a deleveraging period that gets pretty bad, and interest rates go to zero already, and it's still not good, then they have nowhere else to go, right? They can go negative, but that's really bad. We saw what happened in Japan several decades ago when they went negative. And that's what you really never want to do. If you get to zero, that's one thing. Go negative, whole other thing that no one should do. I mean, it took decades for Japan to recover from that. And some would argue they still aren't fully recovered. So that's a matter of opinion. But that being said, I bring all that because we're going to talk about tariffs today, okay? And what's happening to the Phoenix market. Now, there's an article that the Phoenix Business Journal, which they're really good about reporting on good stuff, right, locally here, they actually just came out with here recently. And this article right here talks about tariffs could bump up home prices here in Phoenix, right, by $10,000 in the area. Now, it's a picture, obviously, of a job site. But let's read and listen, or read, I should say, what they're specifically talking about and why. But it's interesting what they say here, okay? Home builders are expecting tariffs on certain construction materials to impact their costs, but that shouldn't be for a while. That's interesting. Homes currently under construction are being built with materials purchased before tariffs kicked in, said Ken Peterson, Vice President of Sales for Marketing for Shea Homes, Arizona. Now, Shea is a big tract home builder, production builder that we have here in Phoenix. Peterson is expecting tariffs to eventually add $1.50 to $2 a square foot to Shea Homes houses it builds, for a total increase of anywhere between $8,000 to $10,000 per house. Today, since there's inventory shock from the builders, there's an opportunity to get a home at an attractive interest rate and a lower price. Okay. Over the past couple of years, home builders have been offering incentives such as rate buydowns, right? Whereas rates have been in the 7 percentile range. Home builders have spent anywhere between $40,000 and $60,000 on a $500,000 home to help bring interest rates down for home buyers. Now, guys, what does that mean in terms of profitability? Oh my gosh. If they can spend $40,000 to $60,000 on a $500,000 house to get it to be more affordable, therefore to make it more attractive, therefore that you buy the home, how much money are these home builders making per house? That's a whole other conversation. Now, you can't stop that, right? They're going to make the profit. They did the work, kudos to them. But that just shows you that there's room in there when you're looking to buy a new build home. Now, how does this work? Let's talk about that for a second, okay? Now, what these builders go out and do is they call it basically future pricing on maybe a hedge fund or a private equity portion of money, capital, right? And they buy it and they lock it in at a certain rate. Now, to buy down that capital to this rate, they got to pay a decent amount of money, a good chunk of money, to be able to get access to that capital at the lower rate. So let's say they want to buy $50 million, a bundle of $50 million, and they want to lock in a certain price they're going to borrow it at. And let's say they spend, I mean, they could spend, $8-9 million in terms of the fee they pay up front to get that money at 4%, something lower than whatever 3%, whatever it is, right? Lower. Therefore, they can turn around and offer a borrower, when they buy that house, a rate on 30 years of 4.99, because it's above what they are buying it or are borrowing it at, but they had to pay that $7-8-9 million fee, whatever it is, right? But it's not cheap to get the money at that time, okay, that price. So that being said, if rates were to come down and come down quickly, which I'm not saying they are, I don't think that's going to happen right anytime soon, right? In terms of going to 5.5 or whatever it may be in the next 6 months. I'm not saying that at all. But if it were, that would not be good for these home builders who are on the hook paying that big lump fee for a cheaper rate of money, when here come the low rates coming down and the everyday person can now get a rate down at 5.5, let's say, right? That's probably not going to happen. So that's why they're hedging the risk. That's why they're smart. That's why they're going to end up selling houses and continue to keep building through this time. So when the market does turn around, they're positioned nicely with inventory already available, or at least dirt lots plotted on a plot of land they purchased to be able to then go vertical and sell. So this is all smart and long-term planning on behalf of the builder's part. Let's go back to the article. Okay, article continues to talk about that tariffs could create a silver lining for the industry, and economic growth slows, mortgage rates could drop further. Guys, we talked about, that's part of that video I was going to show you guys, is that when economic growth slows down, if you start to create a quote-unquote recessionary period, what's the number one thing the Federal Reserve, the central bank, can do? They can take that arm and lower that lever, lower rates. Now, this got even more confusing because most recently, Jerome Powell came out with the Federal Reserve, and just last time they met here, just a week, I think it was last week or 2 weeks ago, and said they're not lowering the rates. That was kind of confusing for the stock market, for the investors out there, the smart money. And so now, what in the world are we doing here? What are we doing? Well, now but they did signal that they're going to potentially forecast 2 rate drops the rest of this year based upon current economic activity and conditions. So you know how that works. If they say these things, the markets start to get, oh, okay, that's good. They start to price certain things in. But where are rates right now? Okay, let's look here. Rates are at 6.75% today on a 30-year fix. There it is. Okay, there it is. 15-year at 6.15. And look where the ARM is at. The ARM on a 6.25 right now. Now, with most rates, most lenders are pricing in a 1 point fee when you get a loan right now, because they're doing that so they can ensure they're making some sort of money, because there's no prepayment penalty on these loans. And they are assuming that they're in a likelihood where rates will continue to most likely drop over the next 6 months, let's call it 3, 6, 9, 12 months. And therefore, what happens when someone locks in a rate today, buys the house, and then rates drop 6 months from now, decently, they refinance. Therefore, they only had that loan on the books for 6 months, 9 months, whatever it may be. And therefore, they want to lock in some sort of profitability, so they are charging a point. Just a little fun fact, maybe not so fun, but you know what I mean? It's a little fun fact to know that that's what's happening, okay? Let's go back to the article we talked about. Again, most of these home builders have, in terms of the home, because we're talking about, this is a real estate show, guys, we're talking about the effect of the local housing market. We have a lot of production home builders here in the Phoenix area. And with that, we're talking big publicly traded companies that don't play around, and they bundle price things out. And with that being said, they have the ability to already have a lot of materials here, or at least purchase locked in pricing before the tariffs took effect. So they're still able to offer a home without jacking the price up too much, unless they just want to be greedy, right? Let's be honest, okay? But let's look at this article a little further. A lowering interest rate also lowers points to buy down interest rates, he said. That makes it better for us because it's less money we have to pay to buy down the interest rates. Now, here we go. I'm going to talk about a couple of things. Tariffs don't impact inventory homes because materials were purchased before tariffs were in place. We just covered that. Said Arizona home builders like Meritage, Taylor Morrison. You have Lennar. You have these big Pulte, these big companies that are already able to offer the same prices without jacking them up yet because they have these things already purchased. Okay. But up until now, home builders have done a good job of keeping prices as affordable as possible, said Jim Daniel, who's the president of the local R.L. Brown Housing Reports. Okay. So also, too, one of I know Keith here, a good friend of mine here, but Phoenix leads the market in our nation as one of the top 3 creators of jobs in the country. As a result, we continue to create demand for housing. Now, that is true. However, look at this. Yeah, boy, you look at this, you're like, yeah, really? Where's the demand at? Long term, midterm for sure, and long term for sure, that will be the case. No doubt about it. Demand did hit the red mark here at 81. Supply is still not terrible. It looks like it's going or getting worse because there's just not the properties coming off the market. Demand is at 81. And guys, the overall market index, the CMI, is at 79.4. And you guys know what that means, right? That's well below the 90 that it takes to be in a balanced market. 90 to 110, according to the Cromford Market Index, which is a function of supply and demand, is currently well below 90 at 79.4. That is not good. Or if you're a buyer, that could be great. So are people jumping in to buy a house? Well, according to that demand, they aren't. And that's interesting to me because if they can get credit, why are they not doing so? Because they have the ability to dictate terms. I think I know what you're going to say. Pause that for a second. Here we go. April 7th, foreclosures. A lot of you guys had questions about that here recently. They are rising, although they remain a long way below normal at the moment. The chart below shows the number of pending foreclosures in Maricopa County, measured weekly and comparing 2025 and 2024. 2020, the year when COVID struck and lenders introduced measures to slow or prevent foreclosure action. So here you go, guys. Here are the years. Here's current year right now. We are approaching 1,400 foreclosures pending right now. And then, of course, you had 2024, which is in the green. And then you had 2020 in the brown that started high and started to go down because the government started subsidizing everybody when it comes to their lack of ability to go make a living because you couldn't go out and go into an office space and in the public for that matter. Okay. So foreclosures pending are increasing, although they are at a slow pace. Now, remember where we were at in 2009. We were at about 55,000 foreclosures pending. Right now, we're at 1,400. So again, the difference here today, guys, is that the Federal Reserve has the lever to reduce rates, and they still haven't done it. And I think it may be the right move. I think if they start to come down, they need to come down slowly so that it's a slow balance. It's like gas prices, guys. If you go to the gas pump tomorrow, and normally you're used to paying $3.50 for a gallon, let's say, and tomorrow you go there and it's $7 a gallon, you're probably going to say, what's going on here? You're going to lose your mind and probably figure out a way really quick not to drive as much. But if eventually in 1 year it gets to $7 a gallon, and along the way, they just slowly increase the price of gas every week or two, you know, it's 25 cents here, 50 cents there a gallon, then you probably aren't going to curtail your driving as much because you're not going to react so severely to it. And that's exactly what the Federal Reserve needs to do to stimulate the economy without causing a deflationary deleveraging, a bad deleveraging time period, okay? That is my economic opinion at this point for what it is worth. What do you guys think? What should the Fed do? What should the overall economy do? How about the tariffs? You guys agree? Do you not agree? It's highly controversial. It becomes a political thing, and this is not a political show, but I'm curious what your thoughts are, okay? In the meantime, let's go back to our articles here. Again, here's a good one here. A few Arizona public companies unscathed amid tariff meltdown, right? Because you watch the media, holy cow, it's a complete meltdown. One way or the other, right? You really defend it, or you just go, oh my gosh, it's the worst thing ever. We're all going to be poor and blah, blah, blah. But there is, I think, a plan here. And this is what this article is saying. That companies across the country have gotten a walloping on Wall Street because obviously the S&P, the Dow, the NASDAQ crashed, okay? Not necessarily crashed, but went down a lot, okay? 5 Arizona-based public companies saw their valuation drop by more than 20% since the close of trading on April 2nd, just 5 days ago. More than half of the state's companies, 25 out of the 48, saw their price shares drop by more than 10%, guys. That's a big number. Hit hardest was Tempe-based online car seller Carvana, whose shares were down 28%. That's a lot of money that that people lost. Holy smokes in that one. Okay, Phoenix Mining, Freeport, McMoran went from 38, to 29. It's a 23% loss. Amcor Technology down 20%. Western Alliance Bancorp of Phoenix down 20%. So you can see the companies here, Arizona public companies that are based out of here, right? And what they did when it going up or going down. You can see over here the difference between 14% all the way down, down, so on and so forth. So it's interesting. But only 2 Arizona-based companies, public companies that is, escaped losses both in the health industry, LifeStance Health Group, and of course, Journey Medical Corp. Okay, so interesting to see the differences on the plans and what is happening here with local businesses in Arizona. Okay, now the tariffs announced on April 2nd have 2 parts. The first, a flat 10% tariff on most imports, takes effect April 5th. That's already happening. The second, higher reciprocal tariff levied on certain countries, according to the Trump administration, takes effect April 9th. Guys, today is April 7th. So in 2 days, there could be higher tariffs coming down the pike for multiple countries that we trade with, okay? Economists have predicted higher tariffs, a long-expected policy of the second Trump administration, okay? Who pays for tariffs, guys? Did you know this? We'll cover this and we'll, kind of stop on the tariff thing. But broadly, the cost of tariffs almost always end up working its way to the consumers, according to this director of economics at Budget Lab in this previous interview. But in some cases, particularly when customers are price sensitive or the market is especially competitive, costs could get even or eaten further up the supply chain. That's what we're hoping for, right? So it doesn't get passed to the consumer at the very end of the transaction. The cost of tariffs is likely to be highest in the immediate term as companies struggle to rearrange their supply chains and consumers look for alternative products. Eventually, as the markets settle into new short-term equilibrium, Budget Lab expects the April 2nd tariffs to push consumer prices up by 1.3%, combined with all other tariffs previously announced this year. The Budget Lab expects a total impact of 2.3%. Okay, now, what does this all mean? Let me tie a bow on this a little bit. The main reason for tariffs in this situation is to bring manufacturing back to the U.S. So in this situation, it would create a lot more jobs, and it wouldn't all be manufacturing like creating this little tiny widget that has a margin of 2 cents for every one you sell. There could be some of that, but a lot of it will be higher tech. Not all tech, of course, right? But higher manufacturing. And car automakers, right? Ships and boats, things of that nature, which have high profit margins when they get sold. But the second thing is obviously on a national defense standpoint. One of the good things that occurred during World War II, and I know we're not in World War II days anymore, but there still needs to be manufacturing of items when there is a conflict internationally. And so that would help from that standpoint too, if we have those factories that could pivot from, say, producing cars to, things on a defense, a military need. Okay. Now, again, not political, just telling you what's happening right now in the meantime. So hopefully, over time here, and it's not too much time because no one wants to be pinched. Nobody wants to feel like they're paying more for things. No one wants to see their wealth go away in terms of on paper in the stock market. But hopefully over time, and hopefully in a short period of time, companies start to come back to the table. They withdraw some of their tariffs on our goods, and we get back to equal footing to an extent on a lot of the things that we trade with in terms of goods and services, and of course, the trading partners across America. So, or the world, excuse me. So that's where we're at today. Now, enough of this. Let's get back to the local stuff here. That's something you guys hopefully came here for, but I wanted to address that. Let's talk about the VAI resort, guys. Phoenix lacks a amusement park. Not anymore. Now it has a couple of itty bitty ones, but this is going to be a lot grander of a scale. It is still not a Six Flags. It is still not one of these big ones, but it's going to be pretty good. A lot bigger than what we have currently. Like if you go to Coasters, I don't know what it's called, Coasters and something, right? I don't know what it's called because it's so small. It's like one little tiny roller coaster, and that's pretty much it. But this is going to be different. The VAI Resort in Glendale, around the Cardinal Stadium, the Westgate area where the Arizona Cardinals play. Okay, now this is looking to open up this year. That's the idea. The Glendale City Manager Kevin Phillips would like to see the $1.2 billion resort and Mattel Adventure Park before he leaves the city in his 2026 end of his tenure. So hopefully that happens. It's supposed to be the end of this year, we hope. But this is a huge, I mean, the resort's going to be awesome, guys. If you stay in Glendale, in Phoenix, you have to consider staying at the VAI Resort. It is, I mean, you drive by it, and like from the interstate, the 101, you can go, oh my goodness, it is going to be huge, guys. A lot of air, a lot of space, and a huge structure, of course, right? But you have a man-made beach, and you have all kinds of stuff. So it just is going to be really, really cool. Hot Wheels has their own not just like theme throughout the park, but also their own roller coaster, right? As a kid, I loved playing with my Hot Wheels. Like you're on the track and you go up and down and watch your Hot Wheels go through all this loop-de-loops, right? Now you're going to be in the actual Hot Wheel as if you shrunk down and get to ride it yourself. I can't wait. I can't wait. So you need to come check it out with me because, you know, at the end of the day, we're all just a big kid at heart, right? At least I am. Okay. And so anyways, this talks about, there's a rendering right there. It's just really, really cool, guys. You have the adventure park over here. Some of it is indoors. And then you have this huge lake area you can see right here with a man-made beach. And then the resort overlooking all of that as if you were like, almost like, you know, at, you know, Cabo looking over the ocean. That's kind of the idea here, right? With the pools in the middle here by the resort. And then, of course, all this other housing around here and entertainment venues. So it is going to be just something special that Phoenix, I think, lacks, but now will have. Okay, there's another rendering of what it will look like there, too. I mean, just incredible scale. Okay, now let's talk about a few extra things, and we will be out of here for you guys, right? But Sky Harbor is, they are beginning a new construction on a new airport concourse in Terminal 3. That's right, guys. Sky Harbor only has 3 terminals, right? They're all pretty big. Terminal 2, 3, and 4. Now, I don't know what happened in Terminal 1, but there is not a Terminal 1. Don't be confused by that. But in Terminal 3, that houses the 2 major airlines of Delta and and United. Of course, Frontier is there as well. Is going to have a brand new concourse to help distribute all of the passenger activity because Phoenix, guys, is growing and they're having more and more flights every single month, let alone year, at Sky Harbor International Airport. So this is going to be really cool, putting out this brand new concourse, and it's going to be needed at Sky Harbor as we continue to grow. Okay. Now, this is some local news, guys. If you are from the Phoenix area, especially, you know about the Henry. The Henry is just incredible. If you have not been there to eat, you need to go there to eat, whether it's breakfast or lunch, your choice, or maybe even dinner. But it is a special place to go. It's woven to the fabric of the Arcadia area in like the central Phoenix area, if you will. Those of you know who are from Phoenix know where that's at. But they have a second location they're opening in the uptown central Phoenix area, which is kind of cool. There's the concept right there. And it's 6,000 feet. And it is going to be special, guys. If it's anything like the one in Arcadia at all, you will love to go there and check it out. Okay. And again, breakfast, brunch options, coffee bar, lunch, dinner menus, and expansive indoor-outdoor bar with a menu of craft cocktails and curated wines. For those of you who are coming from Chicago or some other place where walkability is a big deal, this is a restaurant you want to frequent because it's all about that neighborhood feel going there and just having just good vibe, great energy, good entertainment, and of course, good people, you know, because you're with a bunch of Phoenicians and we're all good people for the most part. Okay. So anyways, guys, that's what's happening right now. I apologize about the error of the audio on the video. I will see if I can get that fixed and maybe show you the rest of it next week. So until then, guys, thank you so much for your time. Comment below if you have any questions or strong feelings on the tariff situation, what it's going to have in terms of the effect on the Phoenix housing market or the Phoenix local economy. Love to know your thoughts. And we'll see you next week, guys. If you have any questions, call me at 480-660-5974. Thank you so much, guys. Until next week, Phoenix, go ahead and keep it classy. See ya.